And the stock market does not exist in a vacuum. Most countries have stock exchanges, and not only that, the exchanges, are kind of regulated by the individual countries' laws and regulations. So in this video, I want to talk about legal and regulatory essential for stock market success. The market is regulated by, it is not a lawless entity. It's regulated by government, by laws, in each individual countries. The legal and regulatory aspect of stock market investing ensures fair, transparent market, as well as they are there to protect investors. And so these are the key elements that constitute the regulatory and legal framework in each individual countries. Number one is you have what is called security laws. We have them in Nigeria here and in most other countries. In the U.S., laws like the U.S. Securities Act of 1933 and the Security and Exchange Act of 1934. It regulates securities and issuance as well as trading. Considering what happened in the recession of 1929, the government had to come up with regulations that will regulate the activities of participants in the markets, the companies involved, listed companies as well as investors themselves. So these acts, were promulgated in 1933 as well as in 1934. They are there to regulate both the issuance of securities as well as trading pattern in the stock market. Number two is the regulatory bodies. You have entities like the Securities and Exchange Commission in the US. We equally have, this particular entity in Nigeria, Securities and Exchange Commission in Nigeria. You have the FCA in the UK, and you have the SEBI in India, which oversees market activities and enforces rules. They enforce rules in the market. So every country has its own regulatory body. An exchange, a stock market cannot do without this regulation, else you'll be dealing, operating in a lawless environment, which will not really go well with investors. Investors wouldn't want to invest in a place where, there are no adequate regulations and legal framework to be able to, oversee the activities of traders and companies in the markets. Number three is insider trading regulation. Trading based on non-public material information is illegal. Usually in the US, if you are caught in case of insider trading, you could someone may go to jail. It will attract serious penalty, serious sanction, which may include jail time or huge fine, as the case may be. So the laws are there to curtail or to eliminate or to sanction insider trading on information that are not available to the general public. You have number four here is we have market manipulation laws. Practices such as pump and dump are prohibited. Pump and dump here essentially means people illegally driving stocks, the price of stocks in the market. They will drive it up to a particular level and then they will sell off their position and cash in their money, and the stock will go down drastically and investors will lose their money in the process. It's called pump and dump scheme. It happened in my country many years back during the time of around 2007. I could remember a particular court case involved a brokerage house going to the bank actually gave money to the brokerage house to bid up the price of its stock in the market by entering large orders, and then the stock price went up so that they can have their IPO at a higher stock price. That's illegal, of course. I don't know how the case ended, but it went to court actually. A culprit were charged to court. Number 5 is a disclosure requirement. Public companies must disclose financial and material, events, information that are relevant to their shareholders. They are required by laws to disclose this information. Everything that is material, that is crucial to investment decision making, that will help or warn the investor of impending opportunities or danger must be revealed by the company. Number 6 is stock exchange rules. Stock exchange, the exchanges set rules for trading and listing, and they equally monitor compliance. You want to list a company in the market, there are rules that you call those rules listing requirements, and after listing, you have to comply with those requirements to remain, to still remain in the exchange. You don't break those rules. Number 7 is investor protection. Entities like SIPS protect investors if brokers go bankrupt, and regulators promote, investor education. They they promote investor education. Apart from what we are doing here apart from what I'm doing as a financial YouTuber, the exchange probably have a way of educating the public about stock investments. It's very important. In case a broker goes bankrupt, you can very easily recover your shares, sell it when necessary. Like in my country, CSCS is there to recover your shares in the case where a broker goes bankrupt, or maybe a broker is sanctioned, maybe a broker is banned from trading. Number 8 is what is called the AML and the KYC regulations. KYC means know your customer. So brokers must verify clients' identities and monitor for suspicious activities. It happens to me once. I discovered I couldn't log into my trading platform. I discovered that there's that particular instruction to bar clients from trading until they update their their documents. We have to update our passports, our IDs, and all other relevant documents you need to open a brokerage account. And once the update was done, immediately I was able to have access to my trading platform. They know how to catch us, because once you are banned from trading, you are banned from investing, you will find every means and to be able to hasten up the process of updating your items so as to be able to trade. If you don't trade, you may lose money. If you don't invest, you may lose money. If you cannot sell, you may not be able to meet up with pressing, financial issues. So number 9 is tax regulations. Investors or investment returns are subject to taxes, including capital gain tax and dividend. In my country, I know of dividend being taxed, but as per capital gain, I'm not very sure. Not very sure. Maybe the tax will come in as part of what your broker charges. A percentage goes to the government. Probably that could be the capital gain. I think I've not really taken time to analyze those figures. I ought to. I think I'll need to. Number 10 is ESG and CRS regulation. Companies must disclose environmental, social, and governance practices, as well as some corporate social responsibility. So in their annual report, they will tell you, they will list their CRS, activities to boost reputation and to garner goodwill. So this particular one needs not to be enforced. And the companies are very happy telling you how good they are in their annual reports. Number 11 is fiduciary duty. So brokers must act in their client's best interest. It is called fiduciary. You act based on your client's best interest. So that's how to discharge your fiduciary. They discharge their fiduciary responsibilities. Number 12 is international regulations. Investors must be aware of cross-country or cross-border regulations in other countries. As an investor, international investor, you should be aware of all those things. Number 13 is emerging trends. New regulations are emerging for digital assets like cryptocurrencies, algorithm trading, as well as high frequency trading. You discover that very soon, cryptocurrency and other digital assets will be fully regulated. But now governments are still kind of dilly-dallying on the matter, but as it gains widespread acceptance, you discover that the regulators will come in to register their presence for the safety of investors. So these rules protect investors, ensure market integrity, and promote transparency, in stock market activities. So the market cannot operate in a lawless environment. There should be sanction, there's regulation, there's that legal framework that governs, trading activities, that regulates the activities of all market participants alike. So it guarantees investor safety and the safety of your capital.